Hi, everyone. It's great to have you with us. I am your host, Brian Rogers. And here's a situation that many investors may be all too familiar with. You've identified a stock that you'd like to buy, but it's sitting at a price or trading at a price that's way beyond your budget. So what do? Many of us might just simply throw up our hands and look for other opportunities. But there is a way you can snag that stock for less than the sticker price. And it involves an option strategy that we're going to dig into within this webinar. It's called the stock replacement strategy, and it can allow investors to gain exposure to stock options that would otherwise be out of reach. Here to walk us through it is Tony Zhang, Chief Strategist at OptionsPlay. He has more than a decade of experience in the options market, and we're going to discuss how to use options as a stock replacement, some of the factors to consider when building out this strategy, and his personal approach to putting it together. Tony, thanks so much for taking the time.
Thank you so much, Brian, for having me. Really looking forward to talking a little bit about options today.
Yeah, I'm excited. I hope you are as well. And now, before we get into the nuts and bolts of the stock replacement strategy, here's a trivia question for our audience. So LEAPS, L-E-A-P-S, it's an acronym. It stands for Long-Term Equity Anticipation Securities, are a type of long-dated option on U.S. stocks that are often used in a stock replacement strategy. What is the longest time to expiration that a LEAPS option can run? So stay tuned until the end of the webinar, and we're going to get to our answer a little bit later. All right, so let's get into our discussion. For starters, what are traders aiming to accomplish by using a stock replacement strategy in the first place, Tony?
So a stock replacement strategy is really trying to replicate buying or taking a long-term investment in a stock, but using an options contract to do so. And there's a few different reasons that, generally speaking, we see traders do this. You mentioned before, perhaps you've identified a stock that from a price point perspective is outside of your budget. So to buy 100 shares of the stock, you may not have enough capital to purchase 100 shares of the stock, but you might have enough capital to purchase a single call option that controls the 100 shares of the stock that you're looking to purchase. However, not only is it suitable for investors who may find that the stock price is outside of the budget, even if it is within your budget, you still might consider taking a look at one of these long-term or LEAP options, if you will, longer dated option, because what it allows you to do is to take advantage of the asymmetrical risk profile that an option provides you that buying the stock does not. Because when you buy a stock, you have asymmetrical risk. If the stock goes up by $1, you make $1. If the stock goes down by $1, you lose $1. Versus an option, you have that asymmetrical risk where you have unlimited upside if you are correct on the directional view of that particular stock, but you have downside protection built into the contract of the call option. So this is really a way that you can use to try to protect yourself from downside. So not only are you, if you're concerned about the stock from a dollar perspective, maybe you're concerned about the stock from a valuation perspective. Also, you're concerned about buying at near all-time highs, even though you think the stock might continue higher. These are ways that you can utilize an options contract to provide yourself some downside protection, because if you look at the risk profile of a long call option, it is similar to buying the stock and at the same time buying a put option to protect your downside. So this is really a way to structure that type of risk profile in a single contract by buying a call option on a stock that you have a long-term bullish view on.
Okay, that's excellent. Well, which type of investor would generally find this stock replacement strategy most suitable?
So generally speaking, we find these traders that are using longer dated options are long-term investors, meaning you've identified a stock that you want to hold on to for at least a few months worth of time, meaning not something you're trying to swing trade, certainly not something you're trying to day trade. Usually you've identified this stock because perhaps of a technical breakout and you believe that there's quite a bit of room for it to run to the upside. Maybe it's a fundamental stock that you believe from a valuation perspective is attractive and you want to buy some of that stock. Or, sometimes what I tend to find that many times for stocks that where you're trying to kind of catch a falling knife, if you will, bottom feed. Many times I tend to find that traders that use this type of strategy are ones that are on a limited budget. But like I said, even for those that have large accounts, this is still a strategy that's suitable because it could provide a little bit of capital efficiency where you don't need to purchase 100 shares of the stock. You only need the capital to buy the call contracts, and this allows you to simply use the funds for other things. So this is one of the ways that you can really get very creative with the use of options and give yourself this asymmetrical risk profile. And that's really the most important thing, I think, for many investors, is to get that upside exposure, but make sure they're doing so in a way with limited risk to the downside. And I think in a type of market that we've seen in 2022, where there's a lot of volatility, we've seen a lot of stocks fall 15, 20, 25% in a single day because of some bad news. Whether it's slowing down in user growth, whether it's inflationary concerns. These are some of the things that where we've seen some very, very big shocks to the downside. And if you're concerned about that, but you think there's some opportunities in the market, this is the type of risk profile that could potentially protect you from that downside while still maintaining that upside exposure with a percentage of the capital that you need to purchase 100 shares of the underlying stock.
Well, let's get into a little detail. So how does the stock replacement strategy work exactly?
Right. So, the stock replacement strategy is actually arguably one of the simpler option strategies because all you are doing is buying a single call contract on a stock that you're looking to purchase. However, it is very specific as to which call option you purchase. Generally speaking, when we refer to a stock replacement strategy, we're referring to buying a call option that expires at least 6 to 9 months from today. Generally speaking, we are buying a longer dated option because the time decay of a longer dated option happens at a slower rate per day. So for each day that you're holding on to this call option, you're losing less to time value, and that gives you a risk profile much similar to buying the stock than if you were to buy, let's say, a shorter dated option, which will have a much faster time decay. But if you buy a longer dated option, specifically a longer dated option that's in the money, that's an option that's going to behave very similar to buying the stock itself, at least in the short run, or for small moves of the underlying stock itself. So generally, we look at options that are slightly in the money. I generally look at roughly about 60 deltas as a starting point. We can discuss kind of what delta means in a minute. But delta gives us a sense for the sensitivity of the option to the underlying stock itself. So for every dollar the stock goes up, you should see about a 60-cent return on the call option for a 60 delta call option. This gives you, again, a risk profile much more similar to owning the stock without a lot of time decay for each day that you hold on to the stock itself. Most of the time that you do this, especially for your average stock, you're probably going to pay somewhere between 15 to 20% of the capital that you would need to typically buy 100 shares of the stock to simply buy the call option. So you're getting a bit of leverage, if you will, on your capital because now you're able to control roughly 60 to 70 shares of the underlying stock while only accounting for about 10 to 50 or maybe 15 to 20% of the cost to buy 100 shares. So you get an implied leverage in there somewhere, 2, 3, 4 times leverage of your capital by using a call option rather than buying the stock itself. Now, for some stocks that are more volatile, you will find yourself sometimes paying closer to 30, 40, sometimes maybe even 50% of the capital that you might use to buy 100 shares of the stock. So it really depends on the volatility of the stock as to how much you're actually paying and how much leverage you're getting on the call option itself relative to the capital that you would have to spend to buy 100 shares of the underlying stock.
All right, so basically there's the potential to get the same amount of gain while risking less money. Now that sounds pretty good to me. But what are some of the limitations or would you say downsides to this strategy?
there is a trade-off, if you will, for that asymmetrical risk profile, and that really is time decay. And it's important for anyone who's buying a call option, whether you're buying a short-dated call option or a long-dated stock replacement strategy like we're talking about today, to understand how time decay affects the value of an option, because the value of the option that you purchase that's going to give you that asymmetrical risk profile actually decays in value each day you hold on to it. And this is a very important concept to understand, because the longer you hold on to a call contract and the closer you hold it to expiration, the more the decay of that option will happen and the faster that it will happen. And that will offset any potential gains where the stock goes in the direction that you expect it to, but the time decay might actually erode in value faster than the stock moving in your direction. And those are two forces that are kind of working against each other. And it's important to understand how much time decay you're experiencing to understand how much the stock needs to move before the strategy is profitable. Another thing that you also have to be aware of is that you don't actually own the stock when you buy a call option. Any dividend that you collect, if you were a stock purchaser, you are not going to collect on the call option itself. And lastly, if the stock starts to decline in value, you can lose 100% of the premium that you pay on the call option. So there is risk. It's important to understand what your risks are when you buy one of these call options. I think it's easy to some degree to understand what the potential rewards are, but it's also important to understand, or arguably more important, to understand what your risks are to the downside if the stock moves. Because I think a lot of traders who first start trading options that don't understand time decay have found themselves in a position where the stock moved in the direction they expected to, but they lost money on the call option and they didn't understand why. And almost 9 out of 10 times it happens because of time decay. So time decay is arguably, I would say, the thing that you have to be most aware of when you're buying a call option, especially one of these longer dated call options.
So the markets, we all know the markets are always changing. What sort of market conditions might a stock replacement strategy be most effective?
First of all, I think bullish or bearish markets are certainly one big concern that investors have. Buying anything in a bear market is going to be difficult to make money on the long side, right? So what you have to identify is whether, generally speaking, you believe that the markets are heading higher or the markets are heading lower. And I think if you're concerned that the markets are going to continue heading lower, that may not be the best time perspective to buy a call option, unless perhaps you're buying on a call option on a stock that tends to be more inversely correlated to the market itself, meaning it's the type of stock that maybe responds well during a bear market. The second thing that you have to be more concerned about as an options investor is implied volatility. So implied volatility of the stock, generally speaking, does move alongside with the market, but they are kind of separate within each individual stock. And it's important to understand when you're buying a call option, how cheap or expensive that call option is relative to the stock's own history of implied volatility. So this is something that what we generally do is we look at the implied volatility of an option over the last year from a risk to reward perspective. It is optimal to buy the option when the implied volatility of the option is near the lower end of the range, because that means you're paying a smaller percentage of the stock's price to purchase that same call option relative to another time of the year where it's more expensive. And that simply means that you're having a smaller downside exposure. You are effectively leveraging your capital. You're going to get a little bit more leverage on your capital if you do get the directional view right. So you're basically skewing the risk to reward in your favor if you are able to buy a call option when it's relatively cheap. And if you buy a call option when it's relatively expensive, meaning implied volatility is near the upper bound of that range, the risk to reward ratio on that call option simply gets a little worse. I would say that the difference between buying near the worst possible prices for a call option versus the best possible prices, it's not going to be night and day, but it certainly will have an impact on the bottom line or the return that you ultimately have on the call option itself. And you have to be aware of certain things like earnings. For example, if we're approaching an earnings cycle for an individual stock, you're going to see the implied volatility or the premium to purchase a call or a put option become elevated. So generally speaking, unless you believe that that earnings announcement is a catalyst for the stock to break out or a catalyst for the stock to really outperform, buying an option right before an earnings is going to result in a call option or a put option that's quite expensive. So sometimes you might want to wait for that earnings announcement to be released before you buy that call option, because then afterwards the implied volatility will tend to collapse, so the value of a call option or the cost to buy that call option will generally be cheaper. So those are the two primary things, direction and implied volatility, that you want to align if possible before you buy one of these longer dated options.
Okay, yeah, this is all really helpful information, Tony. And for those in our audience looking for more perspective on minimizing risks when trading options, check out our webinar. It's How I Minimize Risk as an Option Trader with our guest, Cody Ye. So, all right, now that we understand how the stock replacement strategy works, let's talk specifics in terms of what are the sweet spots that you look for in terms of time to expiration, strike price, and delta when choosing a call option strategy.
Now, while there isn't exact, I would say, best practices per se, I will, share with you kind of how I generally approach buying these stock replacement strategies using a leap. Now, without giving away the answer to your trivia question before, the range as to of a longer dated option or a leap option that's available is quite wide. So generally speaking, when I buy a longer dated option, I tend to find that sweet spot to be somewhere between 9 to 12 months from expiration. Now, while many options or many stocks will have leap options that are listed far greater outside of that range, I tend to find that 9 to 12 months, meaning ones that are roughly 9 to 12 months from expiration, are the ones that are more liquid. When you go beyond 12 months, that's really where the liquidity of these options really, really fall off. And that's why I don't touch the true longer dated options. I would rather buy a 9 to 12 month option and maybe in 6 to 9 months time, roll that option and purchase another 9 to 12 month option rather than buying, let's say, a 2-year option. So 9 to 12 months is generally where I look for from a liquidity perspective. I tend to find 9 is kind of my sweet spot. And then in terms of strike prices, this is really where when you look at an options chain, there are so many strike prices that you can choose, especially these days. They literally list thousands of strikes on a lot of different stocks. It's difficult to understand as to where you start your research. So this is really where you can think of it from a few different ways. You can think of it as which strike price allows me to purchase a relative 15 to 20% of the stock's value. That's one way that you can look at this to determine a strike price. I generally tend to use delta to choose my particular strike prices. And deltas, like I said, they serve a purpose of helping me understand how sensitive the call option that I'm purchasing is going to be to the underlying stock itself. So for every $1 the stock moves up, how much return am I going to see on the option that I purchase? I tend to find that I choose my deltas or start my research looking at the in-the-money option. So about a 55 to 60 delta option is usually where I start my research. There's a few different reasons that I do this. One, that 55 to 60 delta gives me some intrinsic value so that I'm not just paying pure time value, if you will, for the option. If you buy an out of the money option or at the money option, 100% of the premium that you're paying is extrinsic value. That means that value of that option will decay with time if the price of the stock does not move. When you buy an in-the-money option, even if the stock doesn't move, there's some value that will not decay, that intrinsic part. So that's why I like to start with something slightly in the money. I see a lot of traders that tend to gravitate towards very heavy, deep in the money options, 80, 90, 95 deltas even. Now, while that is what I would say a quote unquote true stock replacement strategy, meaning you're going to get virtually one for one with the stock movement, I would argue that you kind of really lose the asymmetrical risk profile that you're really looking for a call option or using a call option when you use such a deep in the money call option. Not only is it more expensive and you're taking on more risk, you also lose that asymmetrical risk profile. So for every $1 the stock moves against you, you're going to lose close to $1. And that's what I don't particularly love about a stock replacement strategy. I want some of that convexity. I want some of that asymmetrical risk, and you're going to get that as you use options strike prices that are closer to the current price. The other thing that I look for in an option is gamma, and that's really this asymmetrical risk profile that I'm referring to. Will have a higher gamma if I start with an option that is closer to the current price of the stock rather than a deep in the money call option that has virtually zero gamma. So I'm not going to get an increase in leverage as the stock goes in my favor, and I'm not going to get a significant decrease in leverage if it starts to go against me. So that's part of why I tend to do my research around the 9 to 12 month expiration date and a strike price that's relatively close to the current price, but that's slightly in the money.
I wanted to circle back because I know we did mention volatility already, but I want to circle back to the idea of time decay. We touched on that a little bit earlier. How might a trader consider the impact of time decay when building out their stock replacement strategy?
Theta is the Greek that tells you how much or how quickly the option decays in value for each day that you hold on to that option. So what you generally want to do is that if you're buying an option, you want to choose options that have relatively small amounts of theta, meaning for each day you hold on to that call option, it's going to decay relatively small amounts. And vice versa, if you're selling an option, you generally want something with large theta, meaning because as you're selling something, you want the value of that option to decay to zero or as quickly as possible. So the general rule of thumb is that you can influence the theta of the option that you're purchasing or selling based on two things: the strike price and the expiration date. So the reason that I was using a longer dated option that's slightly in the money is to try to reduce theta as much as possible. When you buy an option that's longer dated, you're naturally going to have smaller time decay. Each day you hold on to a long dated option, it's going to decay relatively small percentages of the options value per day. Versus if you were to buy an option that expires in 1 week, you're going to see a large percentage of the value of that option decay for each day that you hold on to it. And the other thing that you have a choice over is the strike price. At the money options have the largest theta, out of the money options and in the money have the smallest amount of theta. So this is really where you're using the combination of expiration dates and strike prices to try to offset the amount of time decay. So when you're buying a longer dated option, when your goal is to hold on to that option for quite some time, you really want to do as much as possible to reduce theta. And again, for me, that's using a longer dated in the money option are two ways that you can reduce the time decay factor of an option. And it's important to understand kind of theta across the entire surface, if you will, or the entire options chain from both expiration date and strike prices to help you determine if you're buying an option, where do you want to buy, and if you're selling option, where do you want to sell.
And for those, if you're wondering what's going on with these mentions of the Greeks, when I first started trading options, I thought, Delta was an airline or Theta was like a fraternity. You hear all these names. So for anybody, if you're like me, if you're anyone in the audience, you're not sure what these Greeks are, we do have a webinar that's how to apply common option Greeks. That's going to be available to everyone to watch. So if you're looking to learn more about them, then watch that. And but I thank you so much. Tony has done a great job of explaining some of those already. But if you need a little bit more information, we do have that available. Okay, so that's going to end up doing it for this presentation, or the portion of the presentation today. Thanks for walking us through the stock replacement strategy, Tony. Now I wanted to hop inside of WebBroker just for a second to show our audience an example of how to do this strategy, how call options can differ in price depending on the variables we've talked about today. So we'll look at a lot of the things Tony had mentioned. And so let's hop into WebBroker and take a look. Hi everyone, I'm going to give you a virtual tour of what you would want to look for in WebBroker when you're doing a stock replacement strategy with an option. So specifically, we're going to be looking at a call option for Apple. Remember that this is just for discussion purposes only, not to be deemed as advice. You can use any option on any stock or any stock that has options, I should say. So we're going to click on the option chain. And when we pull down the option chain, we're going to see a tab that says Analytics. So you can see right now, if it has the plus sign, the ability to click the analytics, that means you're just looking at the regular prices. But if you click it again, you're going to get that little minus sign, meaning that you're showing that those extra values that Tony mentioned today, such as delta and historical volatility, we have implied volatility, and we're also going to do that calculation of what is the replacement cost as well. But first, as we're looking, the reason we're doing this is we're looking for a strike price. What kind of strike price do we want to choose? So first, let's look at historical volatility is roughly around 28, and we can see this implied volatility column as we scroll down. We're going to see that the implied volatility, and as we get to this dark green line, remember that's the at the money price. This is currently what Apple is trading at. We can see that the implied volatility, which is, remember, just as a reminder, is what is expected to happen from a volatility perspective versus what has historically happened. And if those numbers are fairly in line, then that means, what's expected to happen is in line with what's been happening from a volatility perspective. If it's a lot higher, if these numbers were in the hundreds, for example, or if it was 70 or 80, you might find that the option prices, these premiums, are going to be much higher, and you may want to wait for a different time or look at a different stock because it could be something that you may not want to pay that higher premium if you don't expect that big of a move on the stock. If it does seem valid, you could consider that, but that's a consideration from the cost, the replacement cost of the option in that sense. So we've looked at volatility. And now Tony did mention delta. So remember, delta is that measure where you can see these deltas for the options that are extremely far in the money, like a $60 strike. The delta, as can be expected, is 1, meaning that if the option, it would almost react just like the stock. Every time the stock goes up by $1, then the option would go up by $1. But remember, Tony mentioned he likes that asymmetric fact where if it's going to go up by $1, you may want the option to not quite go up quite as much as $1, which is not necessarily a great thing on the high side. On the upside, but on the downside, it's more of a plus where it's not going to go down dollar for dollar. So that's where you're going to look for a delta. He mentioned he likes to look at something around 50 to 65%. We see right here there's a $145 strike would be 65%. Remember, that's a general rule of thumb. You could look at something that's a little bit higher if you wanted to have an option with a little bit higher of an intrinsic value. So you could look at 140, 135, so on. And that's where you do that last test of what is the replacement cost. So this is the big one I think that people really want to focus on is what do you feel comfortable with? If you feel comfortable with that idea of 15 to 20%, which is what Tony mentioned, 20% of roughly around $150, which is what options Apple is trading at, would be roughly around $30. So you can see that there's some options here. The $130 strike is around $29.80, so almost $30. That'd be about a 20% replacement cost. If you're looking to go a little bit lower, you could lower your strike. But remember, you're losing a little bit more intrinsic value in the sense that you're going to pay a little bit more here, but it might hold its value if there is time decay. So Tony mentioned, as time goes on, if you get closer to the end of that 9-month time period, you want to have some intrinsic value there. If the stock doesn't move, if Apple doesn't move, then you have potentially some value left over on that option. Okay, because it does lose value due to time decay over the life of the option. So that being said, other than that, you're going to want to pick your own parameters and figure this out for yourself. But as a rule of thumb of some of the things we talked about today, you can look at the implied volatility, you can look at delta, and then you can also look at that replacement cost and potentially select your perfect strike price. All right, thanks everyone. All right, so hopefully that demo helped make sense of some of the considerations and made it a little more tangible for those of you starting out with options. And if you have questions, stay tuned for the Q&A coming right up. But first, here's the answer to our trivia question. As a refresher, the question was, leaps, so the long-term equity anticipation securities, a type of long-dated option on U.S. stocks that are often used in a stock replacement strategy. And we wanted to know in our trivia, what is the longest time to expiration that a LEAPS option can run? And thanks for not spoiling that earlier, Tony. I know you could have. 39 months from their initial listing date is the answer. So according to the CBOE, or the Chicago Board of Options Exchange, which sets out the rules for LEAPS, however, these longest LEAPS only have expiration dates in January. All right, Tony, let's jump over to the live Q&A.